Hello and welcome back to the channel. My name is Peter. We're going to be discussing the stock market and the probability of seeing a parabolic run in the next few months, taking us into a bubble-like environment similar to the years leading up to the 2000.com bubble top. Because we've recently had a major breakout that we've been discussing over the past few days above this price channel resistance, and that's taking us into brand new uncharted waters on the S&P 500 with no resistance above and clear blue skies ahead. So in this video, I'm going to give you guys the arguments that suggest that stocks are heading into a bubble. So we're going to be discussing the margin debt in the stock market because that is one of the biggest factors of any bubble. Are investors using margin debt or not? We're then going to take a look at sentiment. That's a huge characteristic of typical bubble territory that we saw back in 1998, 1999. Massive bullish sentiment. So we're going to take a look at that in 2000 and really take a look at the details. And then we're going to discuss the potential driving factors that could lead the markets higher. So without further ado, let's get right into it. I just want to give you guys a quick background of the monetary policy. We obviously have a very easy monetary environment. The Federal Reserve balance sheet is expanding. They are buying bonds at a very rapid pace, which suppresses the short-term interest rates and essentially provides a lot of liquidity to the markets. And that's a lot of money that can flow right into the stock market. We can then take a look at the United States fiscal expenditure that's obviously gone through the roof over the past few months. This is the result of stimulus checks that are going out to replace any lost income during the recession. And this is all leading to a massive surge in the money supply, which is leading to higher stock market prices. And that's typically the environment where you're going to start to see a lot of margin debt accumulate in the market. You can take a look at this chart here with the red line being the margin debt and the blue one being the actual stock market. And you can see in both the 1999 bubble and the 2008 bubble, we had a surge in the margin debt as investors take on more risk than they are used to because they start to get complacent. Now in 2021, we have had a surge in the margin debt. Now this is the data for February, so we don't know how that looks in March, but you can clearly see that we're on an aggressive uptrend in margin debt. Investors are taking on more risk than they were before. Now you can take a look at our video on margin debt and how it's going to impact the stock market for a full overview of that. But as a quick summary, how you have to understand this is that this is leverage. So this is going to take the stock market much higher, much faster as margin debt is building up. But that exposes investors to a lot more risk when that margin debt is significantly higher. So there was a lot of risk being in the market back in 2007 and same thing back in 1999 as that margin debt was sky high and had a lot of potential to deleverage. But now if we take a look at the margin debt as a percentage of the stock market, right? So this is margin debt divided by the stock market. So you put the two in proportion and you get more of a steady graph instead of seeing margin debt continuing on higher. You want to put these two charts, you want to put these two lines in proportion to one another. And this is the chart that you get. So what we can conclude from this is that back in 1999, you had a parabolic run of margin debt leading up to the top. And same thing between 2006 and 2007. In fact, if we take a look at where we are in 2021, we're currently at similar levels to where we were in 2006. So what this chart tells us is that we could still have quite a bit to run in terms of margin debt. We could still see a parabolic run leading up to 2.8 times the stock market. And if we see that type of move, that would increase the likelihood of us being near a significant top. So we're not quite there yet. We're still at that stage where investors could potentially still take on a lot more risk. Now, if you're so far enjoying this video, you're learning something new, and you like the way I'm presenting the content, don't hesitate to drop a like. It really helps our videos out and makes our channel be able to grow. So thank you very much. Now we're going to move on and talk about sentiment. So this is the put call ratio, the robo put call ratio. So it's specific for retail investors, and we're going to be using this put call ratio a little bit differently to how we usually do it. Usually we use this put call ratio to time specific tops and bottoms in the markets, right? You can see this overextended reading back in April 2010 coincided perfectly with that significant top, and then that spike in the put call ratio coincided with the bottom of that correction. So in general, when most retail traders are going short on the market, that's when you want to be going long. And when most are going long, you want to be going short. And that's also how we were able to time that bottom of the March crash, as that put call ratio was getting extremely overextended and we expected a short-term bounce at those levels. So that's the first use of the put call ratio. But how you can also take a look at it is by going on the longer term chart and see how long this ratio stays overextended to the downside or to the upside. And that tells you whether or not the market is filled with complacency or with fear. And so I'm going to add a moving average on this indicator, a 50 period moving average right here, that green line that you see. And you can see what's going on here. We're seeing the put call ratio dip significantly below that red line. So it's staying overextended to the downside, meaning the number of calls to puts is extremely high compared to previous periods. Unfortunately, we don't have data going back to earlier than 2000. But you can see leading up to that top, this was the top of the 2000.com bubble. You had this put call ratio extremely low for a significant period of time. So this is something that we're closely watching. Are we going to continue seeing this put call ratio stay this low for an extended period of time? Or are we going to start seeing some spikes back to a fearful environment? Now, the fact that we broke out here, you don't see that every day. And unless we see a big, massive false breakout, it's unlikely that we're heading into a fearful environment. This is going to lead into more complacency over the coming months. So this is something that you need to be watching out for if you're looking to identify a bubble in the stock market, which could be starting to develop as we speak. Now, the second indicator that we're looking at in terms of sentiment is the AAII survey. This is something we take a look at all the time on this channel. And so same thing, this is something we've discussed before. We usually use it to time specific tops and bottoms with these individual spikes that usually correspond to significant tops in the market. But that's during a normal, healthy bull market. You can see what happened between 1997 and 2000. You had a cluster of these extreme bullish readings that told you that the market was being extremely complacent and not pulling back when sentiment was overheated. So in 2021, we already have two of these readings, and we're starting to break out again as we're printing extreme bullish readings. So unless we have a false breakout, that's just going to lead to more extreme bullish readings over the coming months, which is something that we expect. Now let's move on to the final point of the video, and that is the potential driving factor. So I've put up a chart of the FANG stocks. This is a combination of Facebook, Apple, Amazon, Netflix, and Google, just to show you their aggregate performance over the last year. And you can see what we're looking at very carefully right here is this huge run up throughout 2021. And that was followed by a large period of consolidation where the markets were not able to break above their previous high right here, or at least they tried but failed to break out above their previous high. But you can see what's happening right here is that we had this nice uptrend line going throughout this period of consolidation, but the FANG stocks broke below, back tested for a while, and over the last few days they've been snapping back above. So what is this? This is a bear trap, and that can often fuel some large moves. And what we're betting on is a breakout of this consolidation range and a breakout back to all-time highs for the FANG stocks. And that could potentially fuel a large rally on these FANG stocks, similar to what we saw in 2020, fueled by extreme bullish sentiment and margin debt that takes these stocks higher. These FANG stocks are what the market has been about for the last decade. This is what has pushed the entire bull market since 2009. It's been in great part due to these big tech stocks. So let us know in the comments below, would you be surprised to see these FANG stocks head into a parabolic moves in these easy monetary conditions that are starting to lead to complacency in the markets? Now, if you scroll down to the description, you'll notice that we have a free trial for our premium content on gameoftrades.net. Unfortunately, we're gonna have to remove this option in the next few weeks, so make sure to go and test out our service on the free trial while it's available, especially if you like the content that we bring to you guys. You're interested in our investment strategies on global markets, on cryptocurrencies, on precious metals, where we display to you guys our research, our analysis, and where we think the market's heading and how to benefit from all of that. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.